before we get into the selection of the stocks, let's focus on how we're going to run the fund and some sort of core values and goals. Number one, do we all agree just Australian stocks, listed stocks, makes it easier?
Yes.
Happy with that? Happy with that, Nathan?
That sounds good.
Okay. High conviction growth fund. Is that a good thing to shoot for?
I think given our expertise in individual stocks, high conviction sounds good.
Okay.
Yep.
Agree with that? Yep. All right, Ben?
I think you've got to think about, are we, in terms of growth, are we trying to beat a benchmark? Are we going for all out growth or more sort of balanced growth? It might be worth just having a bit of a think about if we want some slower growing businesses as a bit of defensiveness.
Okay. All right. So how do we benchmark ourselves? Well, it's been suggested to me that I think Lonsec measure high growth funds. Yep. Do we want to shoot to be in the top 25% of those funds as measured by Lonsec? Does that give us a benchmark?
Yeah.
Sounds good.
Definitely.
Absolutely.
We need a benchmark, so it might as well be that.
Okay. All right. That one rather than an index?
Yeah.
Yeah,
Why?
I think otherwise we're sort of hugging an index probably, especially on the Australian market. You're sort of confined to just having banks and miners, which form the majority of the index. And having a look at our investable universe, a lot of those stocks probably wouldn't even be included in the benchmark 200.
Yep.
And the other problem with the ASX 200 now is that BHP is such a behemoth in the index. Today, even the ex-dividend, 45 points of index was BHP's ex-dividend. Yep. It's a massive chunk of it now. So I think it's not a great benchmark looking at high growth, high conviction stocks.
Yep.
So, and it's also good, I think, to focus on absolute returns, because it's all very well to say, we've lost 10% of money and the index has lost 13% of money. Aren't we doing well? You still lost 10%.
Yep.
We want to be guys that are making 10%, regardless of what the index is doing.
All right. So, Nathan, you happy with that?
Yeah, sounds logical.
Okay. So, do we add an extra filter there that will never lose money?
I don't think that's a possible one.
Yeah. I think
that's the challenge.
No, I think where that comes from, losing money, is thinking about sort of the risk profile of the fund. Often if you're aiming for the sky, what you're doing is taking on a whole lot of risk, and a growth focused high conviction fund going into an era of rising interest rates where we have seen the tech sector of the market and the high growth areas without profitability sold off heavily. I guess how do we manage, investing in growth versus sort of the market just not liking growth and being value orientated at the moment?
And that's like the big drawdowns along the journey are part and parcel of investing in growth stocks. You either accept that you're going to go through them, and as long as you're in good businesses, you'll come back out the other side. But I think to think that you're going to be able to constantly avoid those through timing or something like that is misguided. Okay. It's just not going to work like that. So, I think if you own the right businesses and you can take a long-term view, hopefully you're going to go through pullbacks, but ultimately you will get good growth returns.
Okay.
I think this is something maybe we should decide on. And Nathan's probably got a view here, whether you think, the market's going to go up or down. Because if you think the market's going down over the next 3 to 6 months, then your growth stocks are going to go down a lot more than the market, perhaps even double that amount. Are we willing to take those losses, or do we take, a view on market direction as well as on companies?
I think you've got to be very aware of the macro and the headwinds. I mean, there's no point. I was writing in the newsletter this week about you're in a race car going around the Nürburgring, and there's no point in trying to go flat out around the corners because you're going to have an off. You're going to crash into the barriers. But when the straights open up, that's when you need to have your foot flat to the floor and you need to go for it. And at the moment, we're going through the corners, and there's no point in being gung-ho because it will end in tears. Okay. And it also will affect not only your confidence, but it will affect people's confidence in the concept. If you go too hard too early, you do tend to...
Nathan, what's your view on that?
Yeah, look, I agree. I think Ben's right. When you're investing in growth stocks, you cannot ever say that you're not going to be down, because you are taking a cycle, and cycle will be volatile, especially in growth stocks. The market view is timing is always hard, but you can manage risk. And I think when you're looking at investing in growth stocks, we have to manage what kind of growth stocks at different parts of the cycle. That has to be part of the investment strategy. And there's a time for when when the Fed is cutting rates like there's no tomorrow. You want to be in high growth, high risk opportunities. But when the Fed is turning the other way, you've got to be in cyclical, lower risk growth stories. But there's always growth up there. It's just that you have to be very selective.
Okay. All right. How many stocks in the portfolio, Nathan?
I think you got to be around, 12 to 15, at least in a portfolio to make it. But you don't want to be too big, because once you get past that, you start to deteriorate on your returns.
Okay. What do you guys think?
Yeah, the biggest question for me is, are we going to be able to hold cash or short positions in order to manage risk as well? For me, sometimes I love the stock, but it doesn't mean I'm going to pile in 100% of a potential position. But sometimes opportunities come along to get in at a lower price. So do we hold some cash back for those type of opportunities, especially given that growth stocks are volatile and you usually do get an opportunity somewhere along the way?
I think shorting's too complicated for this. Do we agree with that? Yes. Or do we put it in a short fund or a short ETF? I don't know. Is that the option?
The thing with shorting is you've got to be a lot more active, I think.
Yeah.
And if we're meeting once a month to discuss what's going on, I think it's going to be difficult to say, okay, today's actually the day we should close out a short.
Right.
So it's going to get tricky.
So do we manage market volatility with cash or no cash and just stocks?
I think it would be good to have a cash component, because the volatility that we're seeing at the moment in the market does present opportunities. And I know a week is a long time in politics, but a day seems to be a long time in the stock market at the moment. So I think it's good to have that cash buffer so that you don't have to sell something to buy something else.
Right.
Because it may be that there's something you're selling has taken a pounding, and you've got no choice but to sell that to buy something else. So
Okay, don't forget, we are choosing the portfolio from stocks already in the Calls Fantasy portfolio, and we go every month going to get the buy recommendations and the sell recommendations from the Calls panel that comes up to you at the committee to say, do we put this in or not? Or do we sell something that's already there? So that's sort of the filter and the concept coming through. So
I think
don't
having
have a lot of leeway.
maybe like up to a 10 or 15% cash weighting's a good idea, because I agree with Henry, you don't want to have to sell something if a good buy does come up, if the market keeps falling as an example. But this is meant to be a high conviction growth fund, and I think trying to time markets is really hard as well.
All right, let's take a break. We'll be back to talk about investment style. All right, before the break, I think we decided only Aussie listed shares, around 20 stocks, maybe kick off today with 12 stocks, keep an element of cash. We don't short the portfolio. Do we put an ESG filter on it?
No.
Or not? No? Why?
No. I think everyone can make up their own mind about how they stand on ESG, and one man's ESG is different to the other man's ESG.
Yep.
Some people are happy to turn a blind eye, and many people did for years with Woolies, in terms of the pokies and the pubs and clubs and things that they had before the Endeavour Group came along. So I think it's, I think that does narrow your universe as well, especially if you start applying that filter rigorously to mining stocks, which is a massive part of the market, which is a massive growth opportunity as well.
And to some extent, I think we'll be talking about ESG factors anyway. It comes through the risk assessment of the investments we look at.
Yep. Nathan?
Yeah, look, I think ESG, everyone's going to be looking at what has happened, and they've done well, but by default, their universe ignored all the sectors that actually underperformed. They were pretty much a growth stocks play. So they've done really well. So people are thinking, why not hold on to it? But they're going to face the same problem as all growth stocks. So in that context, I think Julia's right. We have the inherent risk of the ESG in the business model. And so we should judge that through that rather than try and put a ESG filter.
Nathan, how are we going to get you all to agree? Because you're the data nerd. You come to this from a totally different way than others will do it. How are you going to approach it?
Oh, look, I think we all trying to get to the same place. So actually, for me, part of going through this process is looking at how other people go through that process. See, for me, it's a logical approach. Go big, then go slide down to the bottom, and you'll see what's left standing. But other people start differently. They start with things that the sectors that they like. They analyze particular stocks. They have preferences. They go through that. So I'm just trying to see personally, just to see how this plays out. It's an education process as well, and I'll learn from the process.
So when you invest, do you go, oh, I have 25% resources, I'll have 10% in healthcare? Is that how you build your portfolio?
We generally have, we do that all the time. So we reevaluate what kind of sectors that we want to be in. They're like our top 10, I suppose the top 3 or 4 sectors. And then within those sectors, then we drill down to the individual stocks that ranks quite well for us for the market conditions that we are facing. So we then pick those individual stocks, we rank through them. We don't, fall in love with anything. We look at the best potential risk return and we go with that. So that kind of brings in the next best idea. So when one stock falls across as a sell for the opposite reasons, then we look for the next best idea in the next best sector, and then we pick that. And we gradually drop and pick. And funnily enough, over the last 3-4 months, we haven't actually made any changes at all. We've actually, I suppose, added more protection, and in that context, added more cash and more protection. But we haven't actually changed much of the portfolio holdings because we kind of saw this playing out earlier, and it's taken a bit longer to come through. But the data was pointing to this happening eventually anyway.
Right. Julia, do we put sector percentages and weightings on the portfolio, or just go with stocks?
Yeah, I think it's hard with a high conviction portfolio of just sort of 12 to 15 stocks to put sector weightings on it, because then most of the portfolio is going to be banks and the big miners, so it probably isn't going to work with a portfolio like this. But having said that, we look at things through 3 different lenses, so the macro lens, the fundamental, and then the timing aspect of it. And my view is, the market overreacts on the upside as well as the downside, which provides opportunities. And for me, the worst thing is buying a fantastic company where the share price does nothing for like a year or 2 years. Yeah. So just having a look at sort of the timing aspects and make sure, the fundamentals and the technicals are saying the same thing.
Right. Ben, what filters do you use?
Look, for us, it's a bottom-up approach. It's probably a bit the opposite, where we really try and listen to as many businesses as we can. I would say there's probably like a legacy portfolio of businesses that we've just been following for years, and our, sort of my overriding view of it all is if you see a business continuing to track ahead and to do what it's saying it's doing, you can sit with it, and the share price over time will follow that progress. But I also think, in terms of weightings, I think that there are some businesses which have more dependable growth, and there's going to be others where it's a bit more cyclical, and there's probably some things that need to go a bit more their way, and you got to think about the weightings on the back of that. So because weightings are going to be, if we've got say 15 stocks, you're going to need about a 6% position in each one, and if you take a 3% position in something, you need to take a 9% position in something else just to average that out. Yeah. So we're talking about, there's 3,000 odd businesses on the exchange. To get it down to 15, we're talking, I think you've got to look at the individual businesses, and that's the way I approach it.
Henry, how do you approach it?
Carefully sometimes. I'm a narrative guy. I like stories. I like the narrative. So that kind of draws me towards sectors that I see that have got really good potential, like lithium, which we were quite early players in that game, and putting money in there. So that's been good. So I guess for me, it's a bit like Julia, looking at the macro stuff, and then the fundamentals, then the technical. I'm not a technical analyst, but it does, after doing this for a long time, you can, it doesn't take a genius to look at the chart and go, well, that doesn't look good, does it? That really doesn't look good.
Nathan, you offended by that it's easy as that, looking at the chart and just going, well, you don't need to be a genius?
Well, surprisingly, the psychology of it is when the chart looks bad and you're already in it, you're probably telling yourself, no, it'll come back, and it doesn't. Once momentum turns on you, the classic saying, if you had a multi-year upgrade cycle, when you get the first downgrade, get out, because then you get into the downgrade cycle. And the technical analysis is very similar to that. So I think chart does tell you something. I think if you ignore any aspect to investing, then you're hurting your own returns. I think you've got to look at it in a multi-dimensional approach.